Everyone in real estate is going to be shouting about rate cuts, but let me explain how mortgage rates actually move so you don't find yourself waiting for something that already happened. Because once you understand the order of events, you can make a smarter decision when choosing your rate. You see, last week's inflation data barely moved the needle. Markets are focused on jobs. After the August 1st and September 5th jobs report, rates dropped quickly and then traded mostly sideways between the reports. Labor data on September 4th even started a lead-off move that turned into two-day slide once the weak September 5th report confirmed it. Now, why does a Fed cut not automatically drop mortgage rates? The Fed has said recent labor market weakness matters more than the still elevated inflation when deciding to cut. Traders price those expectations in advance, which means bond yields and mortgage rates usually move before the meeting. Because of that, this week's cut has almost no fresh significance for mortgage rates. Today's rates already reflect the same information that made a cut likely, which means we need to avoid repeating last year's mistake. You see, rates jumped last October not because the Fed cut, but because the October jobs report came in much stronger than expected. If early October jobs surprise to the upside again, rates can bounce. So what could shake markets this week? There's actually two things that can jolt us in the short term. First is the Fed's dot plan arrives on Wednesday. Markets are expecting 3 separate quarter point cuts total in 2025. If the dot shows more members favor only 2 cuts, rates can pop modestly. The second is the bigger swing risk remains the early October jobs report. A strong surprise there would outweigh the dots. So my plan for buyers currently right now, if you're inside the 30-day window up to closing, consider locking now with a one-time float down or renegotiation option. That protects you if the dot pushes rates up, while keeping a path to improve if early October jobs are soft. If you're 45 to 90 days out, I would prepare 2 separate scenarios. One being locking after a dip in weak jobs print, and the second would be keeping payment cushions if the report beats. Bottom line, everyone is talking about this week's rate cut, but the market already priced it in. Last week's inflation did not change the story. So I say watch the dot plot for a wobble and watch the early October jobs report for the next real move. If you want help navigating the season, shoot me a DM or let me know down below in the comments and I'll be happy to walk you through your unique scenario.